Detonation, an update by MBMG Investment Advisory, July 2022. Total US borrowing, the teal-coloured line, which is generally in the middle of the outlying lines, has during the last 5 years and prior to that grown roughly in line with the growth in economic activity, which is the maroon line. Although there was a significant temporary divergence during lockdown until the lines briefly intersected again, crossing at the end of the first quarter of last year. What does that mean? Well, within such complex aggregated data, there are many factors at work and many possible explanations, but to us, it seems fairly clear that economic activity encountered a huge exogenous shock, i.e. the lockdown, which derailed it, and that the emergency borrowing facilities that were put in place by policymakers injected sufficient cash to enable businesses and people to survive otherwise existential threats and to be able to quickly resume activity, and for companies to relatively normalize their operating and borrowing patterns. So is it business as usual? Well, business is rarely ever usual, but something unusual has happened. Economic activity has significantly outstripped corporate borrowing since the end of the lockdowns. There are a number of factors that may help to explain this. Firstly, businesses borrowed so much during the first half of 2020 that they had surplus funds that they were able to deploy throughout 2021 and 2022 without needing to take on further borrowing. So the usual synchronizations have been disrupted. Secondly, US government also injected unprecedented amounts into the economy during the lockdown, which has also boosted GDP. Thirdly, we have to be aware that the scale of GDP and the scale of business borrowing are totally different magnitudes. So what we've done is we've put the slide on the right as you look at it that shows the actual dollar size, dollar value of each of these. And finally, we also have to remember that the US economy is primarily driven by consumption. So to fully understand it, we also need to look at personal debt. So what did happen with personal debt? Well, at the same time that corporate debt bloomed, private borrowing actually fell sharply. Now, this makes sense. People were less likely to borrow during the lockdown, and also they received government stimulus payments to help replace lost income. However, the fall in consumer borrowing was more than offset by the surge in business lending, so in aggregate, lending still actually increased. And of course, in addition to this, as we've already mentioned, the US government did inject unprecedented amounts into the US economy. Does it all add up? Well, when we take a longer look at the relationship between economic activity and borrowing, we can see how government spending, the blue line, usually supplements borrowing to pay for increased economic activity, and how in 2020 policymakers were faced with an external shock to the system of such a magnitude it required extreme government funding to fill that gap. We can also see how last year the US government realized that this was unsustainable and they had to return to a more, what might be called, normal trajectory. So did policymakers do well? No, not really. They were doing well, but then they got carried away and they overshot. When fiscal year 2022 began, which was the 1st of October 2021, it looked as though a mythical soft landing, which frankly is something that's rarer than rocking horse droppings in the real world, it looked as if that might be about to happen, or at least it looked that way to policymakers. Government spending was falling sharply, economic activity as measured by GDP seemed to have stabilized, and the increase in borrowing, corporate and private borrowing, was being widely posited as being able to take up the government slack. There are various explanations we can use as to what was wrong with that theory, but actually probably the best is to quote from the BBC comedy series Blackadder Goes Forth. Blackadder says to Baldrick, "You see, there was a tiny flaw in the plan, Baldrick." Baldrick replies, "What was that, sir?" To which Blackadder replies, "It was bollocks." The change in total borrowing from the trough to the start of the fiscal year had been around $500 billion. The gap that lending, that $500 billion was being asked to fill, was around $3 trillion on a gross basis and projected to be about $1.8 trillion on a net basis after collection of taxes and government receipts. There was just no way that it could be nearly big enough. So what does happen now? Well, the inflows, as it shows on the slide, into economies from governments and from borrowing added together are insufficient to generate growth. Therefore, economies are slowing down. It was intended that there would be a slowdown because the level of growth had become unsustainably hot. But the slowdown, which has been exacerbated by policy fears of inflation, has been overdone. This is creating a vicious spiral. In 2021, lending was flat as companies paid back or continued to deploy the huge 2020 funds that they borrowed, and as consumer borrowing grew by 6.7% for the year. But the government, on top of that, injected net funding of $2.8 trillion. Now, that generated GDP growth of around 10% in the US economy, just over $2 trillion. In other words, without government funding, 2021 would have been a contraction or a recession. But we don't need to get too worried about that because that's precisely what policymakers have the potential to achieve. Governments inject funds into economies when they need it to avoid economic contraction, slowdown, recession, depression. However, the assumptions that we used for fiscal year 2022 were based on the US economy being able to function with almost $2 trillion less net funding coming from the government. So how is that working out? Well, economies don't have enough new money from governments and from borrowing to generate growth, so they're slowing. This was apparent during Q4 last year as economic activity failed to keep pace with the increase in private debt. In fact, in inflation-adjusted terms, the US economy actually contracted in Q4 of last year. And it's really come home to roost this year with economic contraction in the first quarter and with widespread fears of a weak second quarter and beyond that. So, Bob the Builder, can we fix it? Well, yes, we can, but not without a major change in fiscal policy, i.e. government spending. Superficially, it may still seem that private borrowing can save the day. As we already stated, in fiscal year 2021, lending was flat and the government injected net funding of almost $3 trillion into an economy that grew by just over $2 trillion. In the first 9 months of 2022, lending has grown by over 10%, and that's been split fairly equally between businesses and consumers. So the total increase in lending this fiscal year amounts to around $631 billion. Even if that pace is maintained, that's an annual rate of around $840 billion. However, we are concerned that the rate is starting to slow. But even that $840 billion would have to fill a shortfall that's been left by the government taking away $1.8 trillion. All other things being equal, that would mean that the US economy would grow not only by much less than last year, which, as we've said, is okay because last year was a blowout year, but actually by much less than the rate of inflation. And when this happens, all things are very definitely not equal. So if we've got credit cards, does that mean there's no problem? Actually, there's a big problem. The build-up in private debt is never the same as when the government spends, because private debt has to be repaid, whereas government debt doesn't. It's beyond the scale of this report to explain why, but I'd recommend Stephanie Kelton's book, The Deficit Myth, which frankly explains it far better than I ever could anyway. Even more alarming is the sharply deteriorating productive quality of private debt at this time, where the main growth, the main take-up, has been seen in credit card usage. Why is that a concern? Well, we've seen deterioration of personal saving balances, and this is a typical signal of impending economic problems. It was a precursor to the recessions of 1990 and 91, of 2001, and it also occurred prior to the global financial crisis, but in a more volatile manner than usual. Personal savings had actually held up very well during the years preceding the COVID-19 pandemic. So this was one canary in the coal mine that continued to thrive. And it's well known that the stimulus policies that were adopted during 2020 boosted personal savings to record levels, both in dollar terms and also, particularly, when adjusted as a proportion of the rapidly declining personal income. However, since then, personal savings have declined, not only back to pre-pandemic levels, but lower, actually back to some of the lowest levels on record, back to the levels that we saw immediately before the global financial crisis, and they're still falling. The company Bankrate reports that the number of Americans who are comfortable with the level of their emergency savings has fallen from 56% 2 years ago to 52% last year, down to 42% this year. And it is continuing to fall very sharply. Now, we don't pretend to know what the tipping point would be, but it's clear that we should all expect much lower consumption within the US economy going forward. Leaders of the major economies, particularly Western economies, seem oblivious to the concerns that we should all have about the take-up in revolving credit and credit card spending, the evaporation of personal savings, increased consumer price inflation, much lower accessibility to credit within a slowing economy, and data that is coming through showing late payments and defaults on debts by consumers. There's usually a lag between people running out of money, delinquencies, and then finally write-offs. Delinquencies were actually at historic lows during the first part of last year, and write-offs were at lows during the second half of last year. Since then, both of them have been rising. While they're still at extremely low levels, the previous cycle low came in 2006. So when we reach a low and we then have a rebound in default and in late payment, that's actually a pretty stark warning that there could be trouble in the not too distant future. After all, we all know what followed 2006. There are warning signs for the US, for the Western, and for the global economies that this latest debt bomb could become extremely dangerous if policymakers continue to fail to tackle it right now. There's very little sign of them showing any willingness to do that.